Okay, good evening. It's Tuesday, October 9th. So today I'm going to do chapter 16. Next week is the midterm. In this class, 6:30 to 8:30. Since it's 2 hours and there's no class afterward. Since people sometimes it's a little bit tight to get here for 6 because you might have a job that finishes at 5 or 5:30. So I start the midterm at 6:30. So on all the chapters we have done so far up to what I'm going to do tonight. So 2, 10, 11, 14, 15, and 16. It's half multiple choice, half written. There's 25 multiple choice questions. A mix of qualitative and quantitative, so a mix of text stuff and a mix of number stuff. And then the other 50% is written problems. I can't remember exactly how many. I think it's 5 or 6, something like that. But it's a total of 50 marks. Formula sheet is provided, so it's the same formulas that you've seen in the quiz. It's the formulas that you see in the slide. Sample midterm from last year. So when I was doing section F, winter 2012. So you have both, as people have asked me in the past, you have both the midterm by itself and the midterm with the solutions. So that's posted in WebCT in the quiz midterm final folder. You also have, if you haven't looked at those yet, very highly recommend. Yep.
If we didn't get our quiz one back, obviously you for that, or is that?
Yeah, I don't carry all the back leftovers. Otherwise, I end up carrying like a brick in my backpack. But I'm gonna be. I have an appointment for an office hour Friday at 1 o'clock. So if you want to stop by Friday, I'll be there from 1 to 2. 1007 1007 Dunton Tower. I'll be there from 1 to 1:30, 1:45, maybe as late as 2. But if you get there around 1, I'll be there because I got a student that booked. And if anybody wants to book, I don't do regularly scheduled office hours because I waste 99% of my time there. There's never I have no problem. I work. I'm a sales guy, so I work based on appointments. You can get an appointment at my office here at Carleton, or if that's more convenient for you, you can come meet me at the Sunbelt office on Riverside Drive, which is right here, just next to across the street from Mooney's Bay. So if you know where Canada Post headquarters is, we're just 1 block south of that. And there, we got, very nice boardrooms, and there's, tons of free parking, so you don't have to worry about, if you have a car, it's actually more convenient for you to come meet me at Sunbelt. So if anybody people have given me pretty crummy grades in my teaching evaluation for being available for out-of-class consultation, but I don't know how much more available that could be by appointment anytime at a location of your choice. So if you complain that I'm not available enough, that's your problem, not really mine. So yeah, I'm available. I check my emails sometimes. Sometimes maybe a day goes by. But when it's near a quiz or a midterm, I check my email because I know that a lot of you like to send me questions at 1:15 a.m. the night before. So I always check my email that whole evening up until the point I go to sleep. So yeah, I'm reachable by email. I'm reachable we can do appointments here on campus or at my Sunbelt office. And I return emails usually within 24 hours, sometimes as soon as I can. But I try to at most be within 24 to 48 hours in the worst case. So suggested exercise, me and the TA over the last last year, and the TA is quite a bit experienced. He's been TAing with me for 2 years now. He's taught this course like 4 or 5 times with me. So we spent a lot of effort writing out the picking out problems out of the book, and I had handwritten stuff, and he typed them all up. Not just the answer, but like the full solution for 6th and 7th edition. Sometimes, people send me some issues because, we started as the first draft of what came out with the instructor manual, but it wasn't that great. But we've been, every time that I teach a course, we polish them, fix them here and there, and the notes, the stuff that I write on the board also. So if you see something you don't understand or something that, you spotted a mistake, it's very possible, usually, 3 to 5 times a term, well, maybe not as much, maybe 1, 2, or 3 times a term, a student will point out an actual mistake, and I look it over, and yeah, that's true. So if you have a problem, the primary contact for me is Mitch_Murphy@carleton.ca. That's any official business for this class comes through that email, and I regularly check almost every day. So if there's anything, send me an email, and if there's a problem with the suggested exercise, I'll look them up. If you have something you don't understand, sometimes, so far this year, most of the questions I see are people that ask me like stuff about, this slide. That helps when you say, slide number this in that day or that chapter, because then I can go to a slide and I know what you're asking about. If you're not specific and you're asking in general terms, it's hard for me to figure out which of the 50 slides you're asking a question about sometimes. But it helps, if you're asking her a slide, say slide 17 of chapter 10 or something like that. All my, I didn't say anything about videos. Well, if you're here, you might not care that much about videos, but in years past, I was using my own website, and I was using QuickTime videos, but lots of people had trouble, so now what I'm using is YouTube. So the channel, there's no space there. So that's all one single word, no space, no underscore. Oh, sorry, not YouTube, youtube.com. Because I've been having some technical problems with the lemma.ca web server, so it's I've had some issues there where it kind of goes down in the middle of the night, and I don't find out till a day or two later when somebody sends me an email. You might not be able to go through lemma.ca, but WebCT usually works most of the time, and the link to the videos, instead of going through Lemma, if it doesn't work, then you can just go straight to the YouTube website, and then that's where all the videos, all my class videos are posted. Any questions at all about midterm quizzes, anything like that? Go Help a Real Business. There's a couple of people that had Go Help a Real Business. I talked to all the owners today, so I sent you an email. Yes, yep.
What's the
30%. Yeah, and there's no, best, in 2504, like they do, 25% one and 55%, or, based on, no, it's 30%. In 2505, it's 30% midterm, 50% final, and no, adjustment on which one you do better. It's just the way, that's the way it's set up. Any other questions? Yeah.
Is it too late to sign up for the Go Help a Real Business?
No. Usually, I don't really say a hard date, but as a deadline. But if you haven't sorted your stuff by the midterm, sometimes people wait till like the last week of class or the second last week of class. I usually say no at that point. But usually I don't accept, stuff too far after the midterm. If you want to set up Go Help a Real Business, try to get it done before the midterm, which is next Tuesday. Yeah. But no, I thought. No? Okay. So that's it for questions? Okay. So tonight I'm going to do chapter 16. Apologies, it's one of the most difficult chapters in this course. Pretty much, this is kind of the top of the mountain. After that, we're kind of downhill, it gets easier, kind of coast down for the rest of the course. Like 17's easier, 21's a little bit tougher. 16's the toughest, 21's the second most difficult chapter in this course. And then the rest, 17, 22, 23, and the valuation are fairly easy. Well, at least relative to, what this course is. But especially 16 is one of the chapters where people have a little bit more difficulty. So, but the key to doing well in this course is just practice. It's like being a professional athlete, like hockey players, skate every morning. Basketball players, shoot balls all day long. It's just the way that it's not, read a textbook, memorize, and regurgitate at the exam. It's more of learn by doing, just do a lot of practice and then you start to get it. So, and you'll see that, just flash forward just a little bit, basically going through the examples and understanding how they're done, that helps quite a bit. So you have the examples in the slides. You have the suggested exercises from the end of each chapter, and you have the sample midterm. So between those three things, you have plenty of resources to practice. And if you do all the suggested exercises, if you understand all the examples, that's 60 to 70% of, because the written part is pretty much all math, and then the multiple choice is about half math. So if you're able to do all the examples, all the suggested exercises, you're already close to 75% of the grade, and then the other 25% is what I call qualitative knowledge. So text stuff. So the best thing is obviously the slides, but it also helps sometimes to read the chapter in the textbook because, it's a different way of, I present a certain way, but maybe if you're reading the textbook at kind of a slower pace, sometimes it sinks in a little better. But mostly this is a pretty heavy, math numbers kind of course. Like how are the numbers problem done in finance? That's more or less what the material of this course is about. And you know that everything I write on the board you can actually get from WebCT. It's called _notes. Okay, so in chapter 16, I would say most of the difficult parts are in 16.2 and 16.3 and 4. .5, .6, .7, .8, and .9 are mostly qualitative type of knowledge. So let's talk about, so this is, what's the actual title? Capital structure. So capital structure is about, remember that in a balance sheet you have two sides. You have the left side, which is your assets. So, you got all your current assets, your cash, your inventory, your accounts receivable. Then you have your fixed assets, then you have your intangibles, and so on. So this is what we call the left side of the balance sheet. So this is what the company owns. On the other side, the right side of the balance sheet, is how the company got the money to pay for those assets on the left side. So remember that you can have some debt, liabilities, and you can have so a balance sheet looks like this. So the left side is what you have, so call it assets. And then you have liabilities and equity. Obviously, this is first year accounting. You should know that by now. And liabilities plus equity should be equal to assets. So when we talk about capital structure, we're talking about this part. But mostly, really, you could say, current assets and then all the other assets. Then you have current liabilities. Mostly what we're talking about is, that's the capital structure of the company. Where did you get the money to pay for those assets? So either you have some loans, or you sold some bonds, or you have some equity, some common shares, or some preferred shares. So this chapter is about looking at this part and how much debt should you have versus how much equity should you have, and how does that affect things like cost of capital. So when you change the capital structure, it should affect the value of the firm. We'll see in a bit. The main theory that I'm introducing in this chapter is what's called Mogliani and Miller. And what they showed is that when there's no taxes, obviously that's not a world that really exists, but they showed that when there's no taxes, then it really makes no difference what percentage of debt or equity you have. The company is worth the same. Capital restructuring means changing the capital structure. So it could be, for example, that you have all equity, and then all of a sudden you raise some debt to pay back some of the equity that you have. Another one sometimes is a company that has too much debt. Then you would raise equity to reduce the amount of debt. Just so you know, I'll tell you in advance, what we're getting to the punchline at the very end of the course today is that roughly, well, it depends on industry and how constant, how stable your cash flows are, but in general, about half equity, half debt is more or less the right answer. Now it depends. There's some industries where it goes one way or the other, but in general, you want all equity is bad most of the time, and all debt is also bad most of the time. So usually you want roughly a healthy balance between the two, and that's the theory that I'm building tonight to show you why that is. So capital restructuring is changing the amount of debt or equity where the mix is. Another way that you'll see this part done is I'll do it as a pie chart where I would say, for example, I have debt instead of liabilities. This is where I have a quarter equity and 3/4 debt. So you increase the leverage by raising new debt and then using that cash to retire or buy back equity or repurchase. And you decrease by selling new equity and paying back some of your debt. So those are the two capital restructuring that you can do. So this is going back to chapter 1. What is the primary goal of a finance person in a company? It's to maximize the stockholder wealth. How do you do that? Well, remember that the value of anything in finance, it's the cash flow divided by a rate of return. So in this case, the rate of return is the weighted average cost of capital that we talked about in chapter 14. So there's two ways to maximize what the value of a company is. Remember that the value of something is the cash flow divided by the return. Well, in this case, we have the weighted average cost of capital. Now, in this chapter, obviously, a way for the company to be worth more is to increase the cash flow that is generated. right? I mean, if you say double the sales and profit go, triple the profit, then the company is worth roughly 3 times more. If you triple the cash flow, then it's the same. But this here, when we talk about a capital structure, we want to figure out the lowest possible average cost of capital, because you can either increase the top of that fraction to increase the value of the company, or you can reduce what you're dividing that cash flow by. So for a fixed cash flow, if I take the average cost of capital down by half, the company's worth twice as much. So this is where what we're going to talk about here today is about optimizing what your lowest possible weighted average cost of capital is. So maximize by minimizing the WACC or maximizing the cash flow. How does leverage? So leverage is the amount of debt. Because earnings per share is what you have left to pay to shareholders after you've paid the interest on your bond. So the more debt you have, what you do, it's called leverage because it has a magnifying effect. So the best way to look at this is through a picture. You can see that if I have a company that has EBIT is a pretty standard way of looking at the profitability of a company, because what you do is you look at the profitability of the company independent of how much of it is financed with equity or with debt. That's why, earnings before interest, the I there is very important. It's the earnings before you pay your providers of capital, the debt holders and the shareholders. So if you have, in this case, say an EBIT of 0 and you have no debt, then the earnings per share is also going to be 0. But if you have 0 of earnings of EBIT, so where would that be here? So the first line here, that one, that starts at the origin. That's the relationship between EBIT and what the earnings per share are. If you have debt, so in this case, I don't know how much debt you have, but what it's saying is that the interest payment per year is $2,000. So if you make 0 EBIT, but you have, I don't know how much debt you have, say you have $20,000 at 10%. You have to pay, that's the thing about debt, you have to pay the interest whether you made money or not. And that's the risk with debt. What happens is, if you don't make enough money to pay the interest payment and the principal payment on your debt, your creditors put you in bankruptcy, and that's game over for your company. But in industries, for example, where there's a lot of risk, they tend to be financed with a lot more equity for that reason. For example, restaurants. I can guarantee you that if you walk into a bank and you ask for a loan to buy an existing restaurant or open a restaurant, you'll get laughed out of that bank, right? There's not a single bank anywhere in town, anywhere in this country, that loans a single dollar to any restaurant, bar kind of thing. Because those businesses are very fleeting. They do well for 6 months, 2 years, 3 years, 5 years, and then they go down. So banks want nothing to do with bars and restaurants. So that's why, well, you might find some private kind of loan shark type of lenders to loan you some debt, but that's why most restaurants, almost all restaurants, are financed with equity, because there's so much risk that you have a bad month or a really slow year, and you don't make enough to pay your the interest on your debt, and then your creditors put you in business. I mean, there are businesses, all they do is sell equipment from bankrupt restaurants. That's probably the only people in the restaurant business that actually make money, are the people that sell used equipment from bankrupt restaurants. just so you know, there's 1,500 restaurants in Ottawa, and I would say that more than half of them, say half of them break even, quarter of them maybe make a little bit of money. There's the odd one that makes, you know, pretty decent, but it's 1 in 10 that actually makes a you know, decent profit. And you know, about a quarter of them are just completely losing their shirt. So, because I mean, I look at probably 20, 30 restaurant financial statements in a year, so I have a pretty good feeling for that industry. The best advice I can give you is just never ever come close to that industry. So what happens is, when you're not making a lot of money, it's disadvantageous to have debt, because if you don't make, see here, you got to make what, 400,000 in EBIT in order to be able to pay your, that's 2,000. Those numbers don't quite look right, but what you want is, at a certain point, you make more money with debt than you do financing with equity. Here's the reason why. One, typically, usually, debt has a lower interest rate than what you would pay on preferred share, what the required return on common shares would be. And yeah, what happens is, oh, the other thing, sorry, that I forgot, is the interest that you pay is tax deductible. You know, you take earnings before interest and taxes, less interest gives you your taxable income. That's what you pay tax on. So if, say, the interest rate on your debt is 10%, but your tax rate is 50%, in reality, you're not really paying 10% on that debt. You're only really paying 5%. Your after-tax cost of debt, remember from chapter 14, RD times 1 minus T, is really just because it's deductible. That's the main, you'll see as we go through this chapter, that's the key difference between debt and equity, is that interest payments are tax deductible and dividend payments are paid from after tax, whereas interest is paid from pre-tax dollars. So it's, you have the tax deductibility that gives you an advantage. So at a certain point, whether you have debt or not, you will have the same amount of earnings per share. So earnings per share is the EBIT after you have paid the interest on your debt. So at that, it's called indifference point, but it's also called the break-even point. At that point, below that point, you better to have equity. Above that point, you better to have debt. So let me show you an example on how to calculate where that point is. So let's look here at okay, the amount of debt. We have 200 bonds. Now I write it out like this, so it's easier for you to understand. But you don't need to write the units in a written midterm or quiz or final. But you do need to write, you know, formulas and numbers. Just I write it out like this so people can understand a little bit better what's going on. So you have 200 bonds at $1,000 per bond. So bond cancels out, so you have an answer in dollars. So you got $200,000 in debt. The interest on that debt now in a quiz, a midterm, or a final, remember that you have to write, you know, the formula with the variables, then the formula with the numbers, then the answer. It's just, you know, this class is a little bit challenging in terms of blackboard space, so that's why, you know, sometimes I skip the formulas. But when you write your answers, I'm sure you've seen, you know, in the quizzes, when the reason why I do put written problems in the quizzes is so you can, you know, if you're going to make a mistake, it's better to make it when it's worth 5% than when it's worth 30%. So here you have 200,000 in bonds, and you're paying 8%. So your annual interest payment is 16,000. The current price of the share, you have $1 million, and there's 50,000 shares. So the stock is $20 a share. So what's happening here is we're using, so this is an example of a restructuring where before you started with 50,000 shares, and that total those 50,000 shares put together were worth $1 million. So you sell 200 new bonds at 100,000, so you raise 200,000 of cash, and then you use that 200,000 of cash to pay back to repurchase shares. The difference is that now the earnings are going to be spread over less shares, but you're going to have to pay your interest payment before you go to that point. So the amount of shares that are going to be repurchased, so remember that delta, that triangle thing, that's for change. So the change in shares is going to be 200,000, and you have $20 a share, meaning that 10,000 shares are going to be bought back. So before the restructuring, you have 50,000 shares and no debt. After the restructuring, you have 40,000 shares and $200,000 of debt. And so the break-even point so unlevered means with no debt, and levered means with debt. So if you look at that picture up there, the equation on the left is the equation of the line that goes through 0, and the equation on the right is the equation of the line that starts at minus 2,000. But in this case, when you have no debt, you have your EBIT that's shared among 50,000 shares. And then when you have the 200,000 of debt, you have your EBIT, earnings before interest and taxes, minus the interest, which is 16,000. And then whatever is left is then distributed across 40,000 shares. So that's the key point to understand about a restructuring, is that yes, you now have less money to distribute to shareholders, but there are less shares out there. So what you want to figure out is what is the EBIT at which it's called, that thing's called indifference, but really this is called break-even EBIT for the problem name. You want to figure out what that X value is. So what you want to do is solve that equation for EBIT. So what I can do is multiply by 10,000 both sides. So I'll be left with EBIT divided by 5 is equal to EBIT minus 16,000 divided by 4. So what that means is, and then you cross multiply, so 4 times EBIT is equal to 5 times EBIT minus 5 times 16,000. So then I can further simplify this as, this minus 4 EBIT becomes 1 EBIT on that side, and 5 times 16 becomes plus 80 on that side, sorry. So if I look at this example here, this is what's happening. So when EBIT is 0, you still have to pay the $16,000 in interest. When EBIT is 80,000, the earnings per share. So this line here is the EPS unlevered. And the line at the top is the EPS levered. So the point at which they meet, if you're below 80,000 in EBIT, you're better to be in equity. If you're above $80,000 in EBIT, you're better to have that debt. So when you would decide as a CFO or a board or an owner whether you should do a restructuring like that, you would look at, that's why we make cash flow forecasts. That's why we make, pro forma, analysis of what we think our, sales in the future are going to be, what we think our earnings or EBIT in the future are going to be. So based on that, it would influence the decision of if we expect to do less than 80,000 in EBIT, you would finance the company with equity. If you expect to do more than 80,000 in EBIT, you would fund. So here, better with debt, and then in this part, better with equity. So that's the capital restructuring break-even EBIT problem. The next one is what's called homemade leverage. The idea being that if you have a company that, obviously, the more leverage you have, if you expect to do, quite well, it's quite advantageous to have more leverage because, for example, in a bank where they might be, 5% equity and 95% debt, the debt being, bonds and deposits, then, if you, say, increase the assets by 5%, you double the value of the equity. So that's why it's called leverage. It's like a magnifying glass. But the counterpoint of that is it goes the other way. If you have a bank that's that's 5% equity, 95% debt, and then 5% of the loans go bad, the equities, the bank is out of business. The equity is wiped out. So that's what happened with the financial crisis, especially in the U.S., is that you had banks that went to, so 20-1 is 5% equity. There's banks that went to 25, 27, 28, where they were financed with 2 or 3% equity. Say if you're financed with 2% equity, 98% debt, and you have a downturn in the economy where 2% of your assets lose their value, the equity of the bank is wiped out, and that's what happened with some of the banks. And so that's why, I don't know, my personal opinion is the best way to control the risk in the banking system is to put controls, instead of having regulations and regulators being in the inside banks and telling them what loan they can't do. The best way to regulate is just to have, and that's a little bit how Basel III is structured, is to put limits on that leverage. And so if you have, for example, 10% equity, 90% debt, you can take a 5% hit on your assets. Yeah, you'll lose half the value of your equity, but you'll still survive to live another day. Homemade leverage has to do with the following. If you own shares in a company where, as an investor, you don't like the percentage of debt or equity that that company has, what you can do is do something yourself, which is called homemade leverage, because you do it from the point of view of the individual investor, or like a pension fund or something, where you borrow. If you borrow and buy shares, you increase the debt. So say I own a company and they're 50% equity, 50% debt, and I don't think that that's aggressive enough. I want to be more aggressive. So what I'm going to do is borrow money and buy shares. What's called buying on margin. What you do is say, you could homemade leverage 2 times. So if the company, say, goes up by 10%, the stock of the company goes up by 10%. If, say, you own 1,000 shares of a company, and then you borrow money to buy another 1,000 shares, then what happens is, if the company goes up by 10%, your investment goes up by 20%. Obviously, the flip side of that is if the company goes down by 10, your investment also goes down by 20. So, for example, one of the things that people do use that that kind of leverage play a lot is in currency trading. They'll lever 3, 4, 5 times because changes in currencies are so small that you can't really make a living as a currency trader by just making 1 or 2%. So what you do is they look for 1 or 2% gains, but then they lever up 5 to 1, 10 to 1. So that's how currency traders make a living. The opposite is if you have an investment which you think there's too much leverage risk, then what you can do is you sell the shares and then you lend money. So that's a way to, in the first case, what you're doing is you're increasing the leverage from the actions that you take personally. In the second case, what you're doing is decreasing the effective leverage of your portfolio by counteracting. So if a company borrows too much and has too much debt, then what you do is you take some of the shares, you sell them, and then you invest the cash that you receive into a debt investment of some other kind, and then you're able to. Actually, if you actually just bought the debt of the company, if it's publicly traded, you could actually achieve exactly the leverage risk, the leverage ratio that you're trying to reach in your own portfolio. Because some companies might be good companies, they're in great markets, but they're just not, they're not optimal enough in their use of debt. Then as an investor, you can tune it up for your own. And vice versa. If a company is too reckless, but you still like the business they're in, then maybe it's a question of you really like the markets, you really like the growth that it's in, the type of industry that it's selling into. Then what you can do is, if you don't like the way that the debt and equity of that company is, you can homemade modify it from your point of view to achieve the debt to equity ratio that you're looking for from the point of view of your own portfolio. So let's do 2 examples, one of each. I'll do those two examples and then it's going to be a good time for a break. So to decrease, so the first example we're doing here is you have an investor that owns 500 shares of stock with a debt to equity ratio of 1.0. But the investor prefers a higher leverage, so more debt than the company currently has. So what do? So to increase the debt to equity ratio, what you do is you borrow and then you buy shares. But how many shares should I buy? So that's how the math works in this one. So before you have 500 shares at $2. So your equity is 1,000. And so if the company has a debt to equity ratio of 1, remember that if you have, this is a debt to equity ratio of 1, the weight of equity is equal to the weight of debt is equal to 50%. So for example, that would be a debt to equity ratio of 3. Right, because you have 1, 2, 3 parts of debt for 1 part of equity. So a debt to equity ratio of 3 is the weight of debt is 75%. And the weight of equity is 25%. So make sure, one thing that I see students having a hard time is they confuse the debt to equity ratio with the weight of equity and weight of debt. Just make sure it's 2 different ways of expressing the same thing. But the debt to equity ratio is more commonly used because it's a way to express the capital structure of a company as a single number as opposed to having to give 2 numbers. Well, obviously if you give 1 they should add up to 100, but you'll see that it's more common in 2505 that when we specify the capital structure of a company, it's given as a debt to equity ratio. So if you have 1,000 of equity and the debt to equity ratio is 1,000, means that your investment also has $1,000 of debt. But you want 1.6 parts of debt for 1 part of equity. So you want to borrow and buy shares. So how many shares should I borrow to get? So I want to get to a debt to equity ratio of 1.6. So I start with 500 shares and that's going to be the debt that's related to my ownership in shares. For example, here I had 500 shares which were worth 1,000, so I had 1,000 of debt. If I had 600 shares instead, then I would have 1,200 of equity and also 1,200 of debt. So this is what you would call the company debt. The company debt. Plus, you're going to borrow the money to buy those Delta S shares. So your total debt from the point of view of the investor, so that would be the company debt, and that would be the homemade debt. What the equity would be is how many shares you have. And obviously multiplied by 2 also. So now what I have is, all this is equal to 1.6 times this. So I can rewrite this as 1,000 plus 2 delta S plus 2 delta S is equal to 1,600 plus 3.2 delta S. Right, so you'll have 1,000 times 1.6, that's your 1,600. 2 delta S times 1.6, so 2 times 1.6 is 3.2. So now I have, that's not an equal, that's an imply. So by cross multiplying that fraction, sorry to give you a bad flashback of high school math there. 1,000 plus 4 times delta S is equal to 1,600 plus 3.2 delta S. That gives you 0.8 delta S is equal to 600. That implies that you want to buy 750 shares. So what you're going to do, did you have a question?
Yeah, is that a plus sign in the bracket? So 500 plus delta S?
Yeah. So what you want to do, here it's not really a question of figure out what the amount of money is. What you want to figure out is how much shares do I need to crank up the leverage with? Then once you know what that is, then you know what the amount of money that you need to borrow. So you started at 500 shares, so you buy another 750, so you own 1,250 shares and you have 1,500 of debt. That's how you can turn the company investment of a debt to equity ratio of 1 to a homemade portfolio of 1.6. This is the whole buying on margin thing. That's essentially the basics there. Yeah.
Where did you get the 1,500?
750 shares at $2. Right? The key to these homemade leverage question is not to try to figure out what the money is. It's to figure out the number of shares. Then you just take the number of shares that you have, you multiply it by the share price, then you know the amount of money that you want. So when you want to do the opposite, when you have an investment and you want to reduce the amount of debt that investment has, then what you do is you do the opposite. You take some of your shares. So if you want to decrease the debt to equity ratio, what you do is you sell some of your shares and you lend the money out. The idea being that the money that you lend out will cancel some of the debt that the company has. So your net debt position is going to be whatever the debt to equity ratio that you're trying to reach. So in this case, well, it's still the same, you still start at the same place as the previous example. So the equity before, you have 500 shares at $2, meaning you got 1,000 of equity. And since you have a debt to equity ratio of 1, that means that your investment also has 1,000 of debt in it. What you want to do, you want to have an investment that has no debt. So what you want to do is you want to figure out how many shares do I need to sell and then invest that into interest yielding instrument in order to have an effective homemade portfolio that has no debt. So in this case, the new debt to equity ratio is going to be so that's going to be the company debt that your investment has. So you start with 1,000, but you're going to have minus 2 times the amount of shares that you sell. And then you're also going to reduce your debt, because if I invest, say, $500 into a bond, and the company has $500 of debt, then effectively what I've done is I've eliminated, I've canceled out the debt that my investment has. That's the key point to understand with this example. Then the amount of equity that you would have is, I just spotted a mistake on the notes. So you want that to be equal to 0. Now, obviously, the solving is a lot easier than the previous problem, because for this whole thing to be equal to 0, we just need the top part to be equal to 0. So that means that 1,000 minus 4 delta S is equal to 0, meaning that delta S is equal to 1,000 divided by 4, which is 250. So if I have shares that have half debt, half equity, and I have 500 of them, if I sell 250 of them, and I invest that into an interest yielding instrument, then what I've done is I've canceled out the debt of my investment, and I've created, so the combined portfolio of having 250 shares that have a debt to equity ratio of 1, and having $500 invested in into a debt instrument cancels out the 500 that the debt from the company is, and that ends up creating myself a synthetic portfolio that has effectively no debt at all in it. All right, so here's a nice point to take a break. All right, it's 7:25, so please let's continue. So so far I had done 16.1, 16.2. So now I'm getting into 16.3, which is really dot 3 and dot 4 are where a big chunk of the knowledge of this chapter are, at least as far as the number stuff goes. So here's what we're going to talk about. Mogliani and Miller were two guys, I think in the 50s. I think they wrote their papers around 55 or 58. And this is a theory, very, very solid theory. This is a theory that has stood the test of time for over 50 years. And here's what they looked at. They wanted to know what amount of debt versus what amount of equity should a company have. So what they looked at is two equations. Proposition 1, which is what is the company worth, and proposition 2, what is the cost of capital of the company. Then at the same time, do I have the next slide? Yeah. Then what they looked at, and this is typical on more in the sciences, how theories are developed than business, but what they were trying to do was applying a very scientific method to finance. Because up until finance had a renaissance between early 50s with Mogliani and Miller and the CAPM, and then you had Held J. Morrow theory of interest rate, but we don't cover that in this course. Then you had Black-Scholes option pricing in 73, I think. So finance, what we would call modern finance, was mostly done between 1950 and 1975. There's been small advances, but really the basics, most of what we teach, at least in a BCom and an MBA, this is stuff that people came up with from 1950 to 1975. So that was a kind of a 25, because up until that point, finance was a very how would you call that? A non-scientific, a very kind of touchy-feely, non-rigorous, non-numbers type of field. When you went through that, 1950 to 1975, this is a period of time when a lot of people tried to bring rigor and bring math and equations, and instead of having finance being something like sociology, they tried to approach more finance to being something like mathematics or physics. So what they looked at was they followed a method that you see more in the physical sciences of developing theories, where what you do is you start with an extremely simplified version of the real world, where you have a whole bunch of assumptions that just basically assume all the complexity away from the situation so that you can understand the very basics of the problem. And then after that, one by one, you pull out the assumptions to then get back up to a realistic theory of the world. So similar, some of you might have taken physics in high school. Remember that when you first start looking at physics and how something moves, if I have like a wheel or something like that that's going across a surface, well, there's friction. So maybe there's a force that's pushing it forward, but then there's the friction that's slowing it down. So if you did high school physics or maybe first year physics, you would have seen math problems when you're like, assume friction doesn't exist. And so you just have the force that's pushing it forward. This is a similar process that Mogliani and Miller use to develop their theory of the capital structure. What they wanted to get to was a theory of at what point you get the highest value of the company and at the same time the lowest average cost of capital. And what they did is they started by saying, assume there's no taxes at all, and assume that you can't go bankrupt. So it's a similar situation to the highly idealized version, what you call frictionless physics. Right? Things are very simple. Then from that, they built up the complexity one step at a time. First by throwing in just corporate taxes, but in their original work, Mogliani and Miller didn't look at the effects of personal taxes at all. Obviously, since the 50s and 60s, if you look on Google Scholar, the Mogliani and Miller papers probably have been cited 5,000 times, 10,000 times, maybe even more than that. So eventually later, maybe in the 80s or 90s, some of the people looked at what happens if you also consider personal tax, things like taxes on dividend or capital gains and so on. But the original work of Mogliani and Miller was start with a very simplified world where there's no tax and you can't go bankrupt. Then one at a time pull out those assumptions to get to a realistic model. So first pull out the assumption of taxes. So start with what you figured out in the original case one, and look at how taxes affect the choice of should I have more debt or equity. Obviously there it has to do, and that's a pretty standard thing in most tax systems in the developed countries, that debt has a deduction and dividend payments don't. And so you have an advantage to having more debt because the percentage that you pay, the part of your cash flow of your EBIT that you pay to your providers of capital has a lower cost when you pay it to debt investors, because the government is kicking in some of it, right, by the effects of tax. Well, obviously the government never really loses, it's the investor that then has to pay taxes later. With equity, you don't pay, the company has to pay their income tax, and then from the after-tax pot of money, that's what dividends are paid from. So that difference of the tax deductibility of interest payments is what makes the change when we look at case two. Then case three, the tax situation stays the same, but originally we had assumed that there's no bankruptcy. And so in case three then we pull out that pin, and then we look at what happens when you do consider that bankruptcy is possible and what are the costs related to that. So the reason why students get confused is because when we look at the Magliani and Miller theory of capital structure, we have 6 different things that we look at. You have case 1, case 2, case 3, and this has to do with the level of assumption and therefore at the level of complexity of the model. And then you have proposition 1 and proposition 2. And then you'll see we have equations for those. And well, when we get to bankruptcy, we don't actually have an equation because you can't explicitly get an equation for bankruptcy costs, but we have a general shape of what the curve looks like. Yeah.
Now, we always ask to show you all the cases or you spend.
No, it's just that what happens is students have a hard time understanding the difference between the proposition and the cases, right? So they mix up what the propositions are and what the cases are. So the cases are about the level of complexity that you have, whereas the proposition are about the proposition 1. So for example, prop 1, case 1 is about what is the value of a company in the simplest case. Then say prop 2, case 3 is what is the average cost of capital when you consider the taxes in bankruptcy. So I'm just giving you a warning up front. Don't confuse cases with propositions. That's something that a lot of students have a hard time figuring out the difference of. But anyway, let's get started. So, the value of a company, you should know that by now, is the cash flows divided by the cost of capital. The cost of capital is represented by a required return, which is that WACC, that average cost of capital. So, that bottom part, I showed that to you when I first started today. If you want to change the value of the company, you can do 2 things. You can, well, that thing is kind of backwards. So I should, right? You can change the cash flows, so you can change the top of the fraction, or you can change the risk of the cash flows. You can change the bottom of the fraction. Now, also that one I should also redo. So here's the idea of, that's the way that the picture is done in the textbook, but let me show you the picture in a different way. So right now we're talking about case 1. So case 1 being, we assume that there's no taxes, and we also assume that there's no bankruptcy. So in that case, if you have a company, obviously companies always have some equity. You can't have a company with no equity at all, because then you don't have a proper balance sheet. I've seen companies where there's 1 share for $1. Well, that's the way it's carried on the books, but the company sells for like 300,000, 400,000, 500,000. So obviously, the guy made or the girl made a pretty nice profit. But the equity, you always have at least 1 cent of equity, because you can't have a company that's 100% debt, no equity. It just doesn't make sense. It's not a proper financial statement. It's not a proper balance sheet. But you can have 90% debt, 1% equity. You can have 99.99% debt, 0.01% equity. But you always have just at least 1 cent of equity. The idea of case 1, proposition 1. So proposition 1 is about the value of the company. Proposition 2 is about the cost of capital. So proposition 1 is about the fraction, the total value of the fraction. Proposition 2 is about what is at the bottom of that fraction. So when we talk about the value of a company, so you're gonna have to know that by now. Unlevered means with no debt, levered means with debt. So if you have, in the unlevered case, you have some EBIT, and if you want to know what is the company worth, it's the cash flow that the company is generating divided by RU. So that would be the required return for the unlevered case. The key insight that Mogliani and Miller came up with in that idealized system of assuming that taxes don't exist is it doesn't matter what share of the company, if the company is, say, all equity, meaning that you can have a company that has just equity and no debt, but you cannot have a company that has all debt and no equity. Because you can have a balance sheet. Here's a balance sheet. You know, the simplest company you can come up with. I have $1,000 in cash. Total assets, 1,000. And I have common shares, $1,000. Liability, total liability and equity, 1,000. Right? That's, you know, the simplest kind of. This is just a company where you have $1,000 that's, you know, deposited into a bank account. That's what you call an all equity firm because there's no debt. So what Mogliani and Miller said in the case of Proposition 1 is that the area, the market value of the company is the same whether, well, this, you know, I'm not a great artist, but just imagine that those two circles have the exact same area. What they said is, so this would be, you know, weight of debt is equal to weight of equity is equal to 50%. Or another way of saying is debt to equity equal to 1. What Mogliani Miller says is the value of the equity in this case, so that would be, sorry, instead of E, call that VU, would be the same as the equity in the levered case, or you could also call that EU plus the debt in the levered case. What he's saying is, this is the situation. If you don't consider the tax deductibility of interest payments, then it doesn't matter if you have all equity or some debt and some equity or almost all debt and just a tiny little bit of equity. The total market value of the firm, the enterprise value, is the same. What's happening is, this is not what's happening, right? By having, say, more equity than debt, you don't raise the value, the total value of the enterprise. This, by the way, is actually what's going to happen when we get into case 2 and case 3. Because debt has a lower cost than equity, then when you have more debt, it reduces the bottom of the fraction, and so it increases the total value of the company. But in case 1, where we assume that that there are no taxes, then it doesn't matter what the split between equity and debt is. You know, you could have half debt, half equity. You could have a quarter equity, 3/4 debt. The total market value, the total enterprise value would be the same. So here's an example here. price of the stock, you have $8 million divided by 200,000 shares, meaning that the shares are worth $40 per share. So the value of the unlevered company is going to be the amount of shares that you have in the unlevered case multiplied by what the price is. So that's going to be 500,000 times 40. So that's 20 million. But if you take, if instead you borrow 8 million, oh yeah, they're going to borrow 8 million to buy back 200,000 shares. That's how you come up with what the price of a share is. Okay. So yeah, this is not the total enterprise value. This is the amount of money that's used to restructure. You're going to go from 500,000 shares to 300,000 shares. So the restructuring here is you start with 500,000 shares worth $40. So the company, the total enterprise value of the company is 20 million. Then you take 8 million, you buy back 200,000 shares, so you go from 500,000 shares to 300,000 shares after the restructuring. So now the value after the restructuring you have 300,000 shares. They're still worth 40 bucks. And you now have 8 million of debt. And surprise, surprise, it's still worth 20 million. So what happened here is this. Before you had 20 million all in equity. After, the total enterprise value is still 20 million, but you have 8 million of debt and 12 million of equity. But the total enterprise value, the total market value of the equity plus the debt always stays constant. That's Mogliani and Miller, case 1, proposition 1. Okay, so in the case of proposition 1, in case 1, the value of the firm is not affected by changes in capital structure. Proposition 2 is the average cost of capital doesn't change either. So it doesn't matter whether the EBIT that we generate, the cash flows, all goes to pay dividends in the case where we're in all equity capital structure, or it goes to pay the interest and then pay dividends. We still end up at the same total value. Now, this is case 1, proposition 2. Yeah. The average cost of capital will stay. Now, the average cost is going to stay the same. This is a bit of a tricky thing to understand here. If I have, say, debt, so if I have equity and an all-equity firm where the return, the unlevered return on equity is 10%, and I add some debt at 5%, what's going to happen is, remember that equity shareholders are a claim on the income of the company and also then the liquidation of the assets at if the company is liquidated, but they're behind the bondholders, right? So from the point of view of a shareholder, the more debt a company has, the riskier it is to be a shareholder of that company. If I'm a shareholder in a company that has no debt, then I know that the first dollar of EBIT that the company cranks out, I have a claim on. But if I'm a shareholder in a company that has 90% debt and 10% shares, then the first dollar of EBIT goes to pay back the bondholders. Basically, all the bondholders have to be paid back in full, the interest and the principal, before I even get 1 cent of my money back. So the more debt, as a shareholder, the more debt that I have in front of me, the riskier it is to own shares. So it's the least risky to own shares in a company with no debt. It's more risky to own shares in a company that's half equity and half debt, because half of the capital structure that's financed by bondholders, they have to be paid back before I get a return on my investment. And if I then say only have 10% of equity and there's 90% of the capital structure in bonds in front of me, then all those people, that 90% of the capital structure, all those people have to get paid back their interest and their principal before I get my money back. So the smaller amount of equity you have in a company, the more risky that equity is, because I'm further and further back. I have a greater risk of getting my money back and also getting a profit. So what's happening is this. The cost of debt is always the same. The average cost of, and that's a thing that's a little bit hard to understand, in that the average stays the same, but it's because you have the debt's always at the same percentage, always at the same return, whatever the coupon rate on my debt is. But obviously at this point here, on the left end of this curve is the all equity capital structure, right? There's no debt. So the average cost of capital is the same as the cost of equity. Now, as I go, if I say get up to, say, halfway where I have, say, half debt, half equity, obviously the higher the debt to equity ratio is, the more debt I have. But that goes just forever, because, for example, a debt to equity ratio of 10 means, a debt to equity ratio, say, of 9 means that the company has 90% debt, 10% equity. A debt to equity ratio of 99 means that the company has 99% debt, 1% equity. A debt to equity ratio of 9,999 means that the company is 99.99% debt and 0.01% of equity. There's not a maximum that, this is not a curve that ends. You can have a debt to equity of 1,000,000 to 1. That that would mean that you have $1 million worth of debt to like $1 of equity. Obviously, companies that risky usually blow up at the first sign of trouble, because they're not able to pay their bonds. What I'm saying is, this is not, the debt to equity ratio is not something that starts at 0 and that ends at a certain number. You can always go further and further. It just means that you have a tinier and tinier and tinier percent of equity, but it never ends that way. Whereas when you look at the point of view from the weight of equity and weight of debt, you can only go from 0% to 100%. So that's one thing to understand about that x-axis right there. So say I'm at like a debt to equity of 1. The cost of debt is always the same, right? Because the difference between debt and equity, besides the interest deductibility, is that debt gives you a fixed return. That's why it's called fixed income. I buy a $1,000 bond, it's got a 7% coupon, I get my $70 in interest payment, and I get my $1,000 when the bond matures. It's not, well, there's some weird, hybrid type of bonds that have what you call quasi-equity, but we don't talk about that in this course. So a bond is called fixed income because if the company doesn't bankrupt, what the cash flows are going to be. Whereas equity, there's a good chance you'll get more, but you might get 0, you might get $150 back for your $100 that you put in. Whereas a bond, you put 1,000, if everything goes well, the company doesn't go out of business and is able to pay their bonds, you get your interest payment during the life of the bond, and then you get your 1,000 at the end. You have what's called a fixed income. So that's why, because it's called fixed income, that's why the cost of debt stays the same, no matter what the debt to equity ratio is. But remember that the more debt a company has, the riskier it is for the shareholders. And so the higher you go to the right, the further you go to the right on this picture, then the higher the required return on the equity that people are going to say, shareholders are going to say, well, if I'm the only one that owns, if there's no debt in front of me in the capital structure, I'm okay, say, with maybe like a 7% return. If there is maybe half of the capital structure is in debt that I'm behind of, then I'm going to want 10 or 12% to invest in that company. If, say, there's 90% debt, then that stock better pay me 30, 40, 50% before I'm interested in investing. Here's the key insight that Mogliani and Miller had. No matter what the split between the debt and equity is, because the cost of equity goes up, the actual average is going to stay the same. If you plot the WACC as a function of the debt to equity ratio, remember, in the case of we assume that taxes don't exist, then it doesn't matter. It's not that the cost of equity is constant, it's the fact that the average cost of the fixed debt plus a smaller percentage of a cost of equity that's going up, the net average of that stays the same. That's the key insight of Mogliani and Miller, case 1, proposition 2. Remember, proposition 1 is about the value, proposition 2 is about the cost of capital. So here's an example. You got the return on assets is 16%, the cost of debt is 10%. So in this case here, if you have no debt at all, the cost of equity would be 16%. When you have no debt, the ROA, return on asset, is the same as the ROE, return on equity. Now, as you add debt, the cost of equity will go up, but the actual, so the cost of equity at 45% debt goes from 16 to 20.91. So this is what's happening here. So RA is 16%. That's when you have a debt to equity of 0. When you get to 45% debt, which is 1.5 debt to equity, then the cost of equity is now up to 20.91%. But if you do the average, 55% times 20.91 plus 45% times 10, you'll stay. That's the key insight, is that the WACC, in case 1 where we assume that income tax don't exist, the WACC stays the same no matter what the debt to equity ratio is. So how does financial leverage meaning the amount of debt? We also talked about operational leverage. We talked about that in, it was in chapter 11 where you have, yeah.
On the last slide, where's the 0.55?
If you have 45% of your capital structure in debt, then you have 55% of your capital structure in equity.
Oh, okay.
And that's equivalent to saying your debt to equity ratio is 1.5. That means the same thing. Remember, there's 2 ways of expressing the capital structure of a company. As a weight of equity and weight of debt pair, or as a debt to equity ratio. So how does having debt affect the risk of a company? So the return on the assets is the risk-free rate plus the beta of the assets times the equity risk premium, which is the index like the TSX 300, the S&P 500, the Dow Jones, whatever, the spread above the risk-free rate. So that's your return on assets. What is your return on equity? It's the return on assets, but it's with the extra kind of boosting factor, the extra magnifying glass of having extra, that's why it's called leverage. So if you have no debt, if you had no debt, then D would be 0. And so that whole thing would be 1. And you would still end up with the equation that you had up there. RE is RF plus beta A times the equity risk premium. When you add debt, what you're doing is you're cranking up the risk of the company. So the beta of the equity, do I have that in a slide? Yeah. The beta of the equity is going to be the beta of the assets as a whole multiplied by that leverage factor. So when you have no debt, then the beta of the equity is the same as the beta of the assets, right? Because eventually the assets are all financed with equity. The more debt you have, the higher the debt to equity ratio is. So say you're at a debt to equity ratio of 3. By the way, that's usually the absolute maximum that banks will do a deal at. You'll never see a bank give you a loan, and even, I'll tell you, like I just got a mortgage, they wouldn't even do a debt to equity ratio of 1. They wouldn't even, I bought a building for $450 and they only gave me $200,000 mortgage on. They wouldn't even give me half the value. BDC will go as high as 75% debt, 25% equity. But the problem is they take 60 to 90 days to approve your loan, whereas my seller wanted something in 15 days. So I had to go with a commercial bank and I had to put $250,000 as a down payment. With BDC, they'll do a deal, they'll give you a loan up to a debt to equity ratio of 3. Meaning a debt to equity ratio of 3 is the situation at the very right at the top there, where you have 3 parts of debt, 1 part of equity. So debt to equity ratio of 3 is the same as 75% debt, 25% equity. That's the maximum when you go and you wanted to go do a business plan and you want to go see a BDC and you want to borrow money from them. That's the highest that BDC will, and even the guys like, don't give me a business plan that has a debt to equity ratio of 3. Do like a 2.5, 2.7 or something like that. But for a commercial bank, at least with real estate lending, they don't go above 65% debt, 35% equity. So those are some points. So if you have a debt to equity ratio of 3, that's quite risky because the person that owns that quarter of equity, the 3/4 of debt, they all have to be paid back before that quarter of equity starts to make a profit. So if you have a debt to equity ratio of 3, then the beta of your equity, which is a measure of risk, is going to be 4 times what the beta of the all equity firm is. So that's a key concept to understand there, that the beta is the actual beta of the assets, but leveraged up by the amount of debt that you have. So here I have sorry, I should have used that. So the return on equity is going to be the return on assets plus the spread. Remember, we have this picture. So this is your cost of debt. this is your return on assets. That difference there, multiplied by the debt to equity ratio, that's what the cost of equity is going to be. The equation for that line here is the equation up there. So, right, because the RA is the intercept, and then the slope of that line is the spread between those two lines. And then the x, this is like, A plus B times x, right? Intercept plus slope times x value. Okay, so that's equal to And when you give percentages in finance, you always give it to 2 decimal points, because that's called a percentage, and then up to that's called a basis point. So this could be said, you'll hear the expression 19.88%, but you'll also commonly hear finance people saying this is 1988 basis points. Because a lot of times, instead of finance people saying, the difference, the spread is 0.5%, they'll say the spread is 50 basis points. It's quite a common way of talking. So, yep.
So in this case, it means that the company has like 19.88 equity and the rest will be the
That's not the weight of equity, that's the return on equity. So the return on debt is 8.5%, and the return on equity at a debt to equity ratio of 0.75 is 19.88. So the other equation is the beta of the equity is the beta of the assets magnified by the amount of debt that you have. So in this case, the beta was 0.95 when there's no debt. But if you have 60% of debt to 40% of equity, then that's a debt to equity ratio of what, 1.5? No, that's a debt to equity ratio, 3/2. Then that would be remember that an investment with a beta of 2 has twice the risk that an investment with a beta of 1. So by going from all equity to 60% debt, that has made the equity almost 2.5 times riskier, because the 40% of debt holders have to be paid before the 40% of equity holders get a cent. Okay, here's a nice spot to take a break. All right, so let's continue. It's 8:18. So now, going back to the progression of complexity in this chapter. So we start with this simplified case, which I've just finished, where you assume that taxes don't exist, or there's taxes, but the tax rate is 0, and that you can't go. There's no bankruptcy. So now what we want to do is we want to make things more realistic by looking at what happens when we consider the effect of taxes, and how does that affect Proposition 1, which is the value of the enterprise, and how does that affect proposition 2, which is the average cost of capital for that enterprise. The key point is interest is tax deductible. So when you have more debt, you reduce taxes. How is that? How does that happen? Let's look at this example. You have a non-levered firm, so a company with no debt makes $5,000 of EBIT. It has no debt, so there's no interest. The taxable income is $5,000. The tax rate is 34%. So the net income is $3,300. And therefore, the cash flow from assets, is $3,300. Look at what happens. If you have, let's see, that would be, I think this is the next one. You have 6,250 at 8% debt, meaning that you have your interest payment is $500 per year. So your taxable income is $4,500. So you pay taxes on that reduced amount. And therefore your net income is $2,970. But remember that cash flow from assets, where did I put mine? So in the unlevered case, you have your cash flow from assets is 3,300, and that all goes to shareholders because there's no debt. In the case of, in the levered case, which is the second one here, you have the cash flow from assets has two components. The net income, let's say that's if you paid, you paid all of your net income in dividends, goes to the stockholders. So you got 2,970 goes to the shareholders, but you also have 500 that goes to creditors. So the total cash flow from assets is 3,470. So you can see that the tax advantage of having 6,250, which your interest payment is 500, that reduces your income that you get taxed on, and therefore the total cash flow to providers of capital, instead of being 3,300, that all goes to shareholders. Now what you have is 2,970 that goes to shareholders and 500 that goes to creditors. So you can see that in the unlevered case, you had a total of 3,300 that went to your providers of capital, whereas in the levered case, you have less that are going to shareholders, but the total that are going to the providers of capital is 3,470. So by having an interest expense of $500, you created $170 more of cash flow. That $170 is what's called the interest tax shield, right? The fact that it's, a lot of students confuse that. Remember the difference between CCA, which is the actual amount of the deduction, and CCA tax shield, which is the amount less in tax that you have to pay. For example, you can have, say, 1,000 of CCA, but if your tax rate is 20%, then the tax shield, which is the amount of tax that you pay less of, would be $200. I'm introducing a new type of tax shield. In Chapter 2, I talked about the depreciation tax shield, which you have a deduction for depreciation, and that reduces your tax payable. In this case, you have a deduction for interest payments, and that reduces your tax payable again. In the case of Chapter 2, it's called the depreciation tax shield. In the case of Chapter 16, it's called the interest tax shield. What is the value of that? Well, this is the cash flow that you get every year, assuming that the company is in a constant state, right? It always generates EBIT of 5,000. It always has the same amount of debt year to year. So what is, remember that if something is generating more cash flow, then that something is worth more. What is that extra value? Where is it coming from? It's the present value of the interest tax shield. Just like you had the present value of the CCA tax shield, in this case you have the present value of the interest tax shield. So what is the interest tax shield? It's the amount of debt that you have times the interest that you pay on your debt. So that's your interest payment. Times the tax rate is how much you save in taxes each year. But here's the key point. What risk level should you capitalize that cash flow at? You should capitalize it at the risk of the debt. And so the annual interest tax shield is D times RD times TC, but you capitalize that cash flow at a cost at the same cost as the debt. So the cost of debt ends up canceling out, and so the extra value of having that tax deduction is worth the amount of debt that you have times your tax rate. So the company is worth 2,100. A company that generates 3,470 in cash flow from assets is worth 2,125 more than the company that generates 3,300 in total cash flow to investors. So here's an example. Oh, sorry, I should have been a little lazy about moving the boards tonight, sorry. So the interest tax shield is going to be the amount of debt that you have times the cost of your debt times what your tax rate is. And so you have 250,000 worth of debt in this example. You're paying 7% on that debt, and the tax rate is 35%. It's a little bit close to the last one where you had, but numbers are close, but this is a completely different example. So if you have a company with $250,000 worth of debt instead of equity, remember now we're in the case 2 where taxes do exist and you have the tax advantage of interest payments versus dividends. Then a company with $250,000 worth of debt saves $6,125 in taxes every year from that deduction. Where did I? Oh, it doesn't matter what the market value is, because what you're going to pay in interest payment is going to be 7% of the 250. It doesn't matter that the bonds might be trading at a value different than par. So you can, in that example, sometimes you see problems like that where there's just kind of extra fluff put in just to kind of confuse you. That equal to 103% of face value, that's a part of the problem you can ignore. So let's continue. The value of the company will increase by the present value of the savings from having that interest deduction. So the value of a company with debt, the value of a levered firm, is going to be the value of the company with no debt plus the present value of that tax advantage going forward. So the value of the equity is the value of the firm. Oh, that's just plain enterprise value. So if you have a stable cash flow company, the value. Remember before that in case 1 we had VU was EBIT divided by RU because T was 0. So when you have case 2 proposition 1 and you're unlevered, then the value of the unlevered company is the EBIT, the after-tax EBIT divided by the unlevered return. And so the value of the that equation up here, VU, that's the value of a company with no debt. VL, V levered, that's the value of the company with debt. It's the value of the company with no debt plus the extra tax advantage, the present value of the interest tax shield. So here's an example here. You have a company with EBIT of 25 million, debt of 75 million, and the coupon's 9%, and the unlevered cost of capital is 12. So VU is EBIT times converted to after tax divided by the unlevered cost. So that's VU is equal to EBIT 1 minus T divided by RU. So the company with no debt is worth 135 million. But then if you had 75 million worth of debt to that company, because of the tax advantage of interest, because of that interest tax shield, the value of the total enterprise value with debt is now 161 million. And so that should say EL, the value of the equity in the, if the total enterprise value is 161 and you have $75 million worth of debt, then the value of the equity would be 86 million. So this is what ends up happening. Now you're going to say, wow, that's kind of crazy. The more debt the company has, the more it's worth. Well, remember that we're developing a theory by assuming that right now in case number 2, taxes exist, but bankruptcy doesn't. So yeah, the more debt I have, the more the company's worth, but we're not quite accounting yet for the increased risk of bankruptcy. I'll give you the punchline that I get to by the end. What happens in case 3 is that curve bends back down because the more the increased value that you get from having more debt, once you get past a certain point, is counterbalanced by the increased risk of bankruptcy, so the curve bends back down. So let's look at the value of an unlevered firm. There's a key point here. It says after-tax net income. So after-tax net income is not just EBIT, it's the whole thing. Right? EBIT, if you don't have any debt, then EBIT times 1 minus T, that whole thing, is equal to net income. So the 125 is not just EBIT, it's the whole top of the fraction. Now, if you have a levered firm, meaning a company with debt, then in this case, the value of the unlevered firm is going to be, well, it's not given as through the value of the cash flow. You're just given it through the market value. So you have 200,000 shares. and they're currently trading at $20, meaning that the market value is 4 million. So the value of the company with debt would be the value of the company without debt plus the present value of the interest tax shield. So that's 4 million plus you have 1 million of debt and the tax shield is 34%. So what's happening here is this. Maybe I'll sketch it here. At no debt, you get 4 million, and at debt of 1 million, it's now worth 4.34. So the company, the equity is worth 4 million, and then the tax advantage of interest on top of that is worth 334,000, right? 34% of 1 million. Here's another example of I'll skip that one. I'm a little bit tight for time. But it's the same concept, except now you're applying that formula. EBIT times 1 minus T divided by RU. So what is the value? That's another one that's similar to, I know some of you stayed for the more examples. I think these used to be in my more example section. Somehow they got rolled into it, but you can try those example by yourself. And if you look at the notes, but it's just a repeat of the last two. Again, that's another repeat. Oh, my things got mixed in. Normally there should have been more examples. So the last three examples there, those are ones that you can try to practice by yourself. Normally I should have had them in the more examples section. So so we just finished case 2, proposition 1. So now let's talk about case 2, proposition 2. So we're still at case 2 where we have taxes but no bankruptcy. But now proposition 2, we're talking about the cost of capital instead of the value of the company. So the average cost of capital, now that WACC there, that equation for WACC is, you should recognize that from chapter 14. Right? That's the first time you saw the equation for WACC. The average cost of capital is the weight of equity times the cost of equity plus the weight of debt times the cost of debt times convert to after tax. You have the cost of equity is RU plus, we have that from, that's the equivalent of, when we did no tax, we just had this. But then when we have the tax, we end up adding that 1 minus T factor there. So what you do is you take that value for RE and this is the example from before. If you look at, those are the numbers where we had, this is this example here, where we had 25 million of EBIT, 75 million of debt. And so the value unlevered was 135, the value levered was 161, which was composed of the 75 million of debt and the 86 million of levered equity. So this is what you know, the total value levered is 161. You have 75 of debt, 86 of equity, so that's here is your weight of equity. 75 by 161, that's your weight of debt. So your average cost of capital is 10.05. So you can see what happened. We started with, if we had no debt at all, then our average cost of capital would have been 12%, right? The unlevered, the ROA, return on assets. RU and RA are actually the same. In the book, they kind of intermix the two, but they actually mean the same thing. It's your return on asset, what you're used to in classic accounting as ROA. Yeah. Say again?
Times 0.1369, is that what that means?
21, no, it's just, see that equation, RE right there?
Yeah.
If you just apply it, you have RU is 12, the cost of debt is 9, the debt is 75 million, the equity is 86, the tax rate is 35%. So, what's happening here is this, at a debt to equity ratio, the equation of that line is RE is equal RU plus RU minus RD DE 1 minus T. So at a debt to equity ratio of doesn't tell, but that would be at a debt to equity ratio of 75 million of debt to 86.67 million of equity. Your cost of equity is 13.69, and this is not flat, it just keeps going. The WACC is down to 10.5. So when you have all equity, the WACC is the same as the if you have all equity, then obviously the cost of equity is the same as the average cost because there's no debt. So at all equity and no debt, the cost of equity and the average cost of capital is 12. At the situation where we're at, where we have $75 million worth of debt, the cost of equity is up to 13.69%, and the average cost of capital is now down to 10.5. Because now what's happening is you have more of your capital structure financed at a lower cost at 9%. So as you have more and more of that, as you have more and more of your capital structure financed at that lower 9%, and you have the tax advantage of interest deductibility, it lowers your average cost of capital more and more. You can see what happens is the more and more debt you have, the lower and lower your cost of capital is. And it's one of these asymptotes, again, sorry about the bad flashback of calculus, that eventually it gets to 9%. But once you have, the more and more debt you have, say you had 99% debt, 1% equity, then your average cost of capital would be, say, 9.05%. So if I have the average cost of capital, right? Well, they're continuing that argument there. So I was at what? More equity than debt. So once I reach 50%, 50%, 50% equity, 50% debt, meaning the debt to equity ratio is 1, then my average cost of capital, remember that here is the WACC curve. Then I'm down now to 9.9. And the cost of equity is up to 13.95%. So, well, there's a nice picture. Basically, that although that picture is not quite the same, the example given in the slides are not quite the same as. But this is the general picture that it looks like. The more, sorry, there's only 10 minutes. You're gonna have to ask the question after the class. So here's an example of. This is really just a chapter 14 type of question. So the equity is 42,000. The total enterprise value is 18,000 of debt and 42 of equity. So that's your weight of equity. The cost of equity is 11.6. Then the weight of debt is 18. And so the total average cost of capital here is 9.61%. So this is an example of the other equation. Remember that when we're in the cost of capital, we have two equations there. We have the WACC equation, which is the average cost for the capital structure as a whole. And we have the cost of equity, which is, remember, the curve at the top versus, well, if you had look at the, so that WACC equation there, that's the yellow line. And that RE equation, that's the blue line. So let's do an example of I'll skip this example, but you can look at it in the when you study. Hint, hint, nudge, nudge. You can look at it in the notes, which are posted on WebCT. And now I have 5 minutes to explain to you what happens in case 3. But the good news is that in case 3, we can't really do any equation stuff because bankruptcy costs are something that, yeah, they do exist. And obviously, the more debt you have, the riskier, the more chance you have of a bankruptcy. But you don't have an exact equation because, put it this way, if I start a company and I buy $1 million worth of equipment, the bankruptcy cost would be that if I'm unable to pay my debt, my creditors are going to put me into bankruptcy, and then they'll sell my assets, and whatever cash they get from that, they'll use to pay back their debt. But if I buy $1 million worth of equipment, I don't know in advance 2 years from now, or maybe 3 years from now, or maybe 5 years from now, what percentage I'm going to be able to get when I sell that equipment. I might be able to get 50 cents on the dollar. I might be able to get 10 cents on the dollar. That event might happen 2 years from now. It might happen 3 years from now. So it's difficult to quantify exactly what the bankruptcy cost is. So that's an example of a bankruptcy cost. And on top of that, you got to pay a bankruptcy lawyer, and you got all kinds of legal fees. You don't know in advance, 3 years from now, how much is it going to cost me to hire a bankruptcy lawyer? When you do case 3, we know that there are bankruptcy costs, and we know that it's riskier and riskier. There's a higher and higher chance that you'll be bankrupt the more and more debt you have. But we don't have, like case 1 and case 2, exact equation. Boom, this is the equation, bang, that's the line. So the actual shape, there's all kinds of direct cost and other costs. So this is what happens. In case 1, you have that green line. Doesn't matter how much debt you have, the company is always worth the same. Remember, that was the key insight of how Mogliani and Miller started. Then in case 2, the more debt you have, the more the company is worth because the more tax advantage of the interest deduction you're getting. So case 2 is the blue line. Case 3, meaning that the more and more debt you have, the higher and higher risk you have of bankruptcy, so the higher and higher your bankruptcy costs are. Then what happens is it takes that blue line and it kind of curves it back down. So the optimal value of a company happens where the top of that curve is. See, you can see that this is one of those, local minimum from calculus. And then at the same time, when we looked at case 2, the average cost of capital kept going lower and lower the more and more debt you have. But the bankruptcy cost bend that curve back up, so you have an optimal point where the average cost of capital is the lowest. So remember that the value of something is the EBIT times, after tax, divided by the average cost of capital. So the higher the value of the company is going to happen where the EBIT is the lowest, right? The smaller number you divide something by, the higher the fraction is. So you end up with this picture. The optimal level of debt happens where the average cost of capital is minimized. At the same time, that's the same point, that's the same amount of debt as where the company is worth the most. So case 1, it doesn't matter where you are, they're all optimal. Case 2, the more debt you have, the more the company is worth, and the lower your cost of capital is. So the optimal amount of debt is as much debt, 99.9999% debt. And then in the realistic case with bankruptcy costs, the optimal amount of debt is where the curve starts to bend back down. It's where the increased value from the interest tax shield is counterbalanced by the increased risk of bankruptcy. At that optimal point is where the optimal amount of debt happens. And then you can just read the rest of the slides while you study. I think I have 1 or 2 questions on the midterm on that. Sorry, ran out of time today. You guys are asking too many questions. Or I'll take a shorter break next time I teach this chapter. So please remember to read the slides when you study the rest that I didn't have.